I feel like we have a good agenda for today. I included a couple of questions in the trading, the trend following club trading invitation, I guess, in the body of that. I don't know if anybody looks at that or sees it, but if you ever want questions, if you want to send me questions, you can do it on Twitter. And I think there's a messaging option on Clubhouse as well. I haven't used it, but I think it's down there somewhere. So, anyways, I'll just go through these questions. And of course, we had a really good time last week and spontaneously got into a lot of good discussion, especially Richard and Derek. That was really fun. So, anyways, one of the questions, I'll just read the questions and you can start thinking about these. And of course, we can talk about them or not talk about them. So Seth's question was basically, what do you do when you run out of capital? You're doing trades and you're not using futures and leverage. Continue taking the trades, trade them smaller, I guess, or adjust old positions, or don't take any more trades. Another question from Anish was in response, I think, to my tweet about how to measure a better way to measure return versus risk for trend followers is to just look at the capital account. Well, return divided by capital account drawdown. And then Anish wanted to know if another way to calculate capital account could be total equity minus risk to stop, which I didn't really understand that in the context that since I was recommending not using open trade fluctuations, we're letting our profits run as a way to measure our performance, return divided by risk. But I know some people do use capital account, total equity minus risk to stop as a way to calculate the daily AUM when you are deciding the quantities for new trades. Then I went on to say that we shouldn't, drawdown in open trades is not real risk. And Richard's response was, it is, unfortunately. Oh, no, not unfortunately. But unrealized trades, drawdown in unrealized trades is real risk. It's another. And then I was interested in if Richard wanted to explain to us further his really good tweets he had, which I think this is a good summary, that trend following, the fact that trend followers trade longer term these days is due to there being more convergent traders and not more trend following traders, which are more divergent. So convergent trading versus divergent trading, I thought that was very interesting, and I didn't really understand exactly everything he was saying. So if you want to, if you want to talk, please raise your hand, and I'll get you up here. Unless I let everybody talk and bring everybody on stage who wants to be on stage, they raise their hand. Unless I get distracted and I miss you, so just keep requesting. All right.
Hey guys, Avi here. Jerry, great to see you again. Lead this talk. I saw Anish's Twitter post about risk, and this is like the concept that I was chatting about a couple of weeks ago, where I'm thinking about my book as what is the tangible equity. I use the term tangible equity, and so what's the value of the portfolio after at every stop loss? So like what's the remaining value if I was to get stopped out of every position I had? And that's that's kind of what I think about as mine, and anything on top of that is noise. I think you talked about Richard Dennis saying it was just the market dance and then waiting to see what happens. So I definitely agree with that, and that's how I've been thinking about what I have out.
If y'all don't mind, that was a great point, Avi. If y'all don't mind, I'd like to just comment on kind of the general industry perspective on trend following and some misconceptions. Um, it's interesting. I was kind of looking at the relative standard deviation, which is super important for if you're adding a given CTA to an existing portfolio. You obviously want it to zig and zag for capital efficiency purposes. Um, and I found for a certain person's fund uh, who will go unnamed, his fund, the mutual fund, institutional class is 14.67 standard deviation, which is above the category average. But within the ETF space, where we've actually seen a spike in flows as more and more folks look to capture alternatives within the ETF structure, it's around 2% standard deviation there, due to obvious constraints with leverage and whatnot. So, and then interestingly, for the hedge fund, the various hedge fund indexes, it's even higher on average, though not as high as the S&P, of course. So, I've just been talking to various prospective clients, and they say, well, if I ask if they have CTAs in the portfolio, they'll say, "Oh no, we wouldn't add those. It makes things too volatile." And I'm like, well, not even on the standalone basis is that exactly true, compared to what you're probably holding in your risk bucket. But I don't know, just an interesting misconception that seems to be very widespread across the industry.
What's one, Brian, today? I'm trying to invite you, Brian, but I'm not sure why it's not working. But I would just say let's separate these two ideas. One is my idea, which I think it's kind of probably difficult to calculate, and that would be something like rate of return. Rather than using Sharpe, let's use rate of return divided by your max drawdown in your capital account. So that is, and then someone commented accurately that you can game that by refusing to get out of losing trades. So I was like, oh yeah, I guess you could game that. So, I mean, I'm not sure why you would, but because that's not going to help. It's not following your system. But I guess so. Maybe one way to adjust that calculation would be rate of return divided by capital account drawdown, but you mark to market your losses. Okay. So that would, take that kind of idea away. But I don't think, it's probably not even necessary because no one cares about this anyway but me. So, okay. Then the other idea is how are we going to calculate our AUM on a daily basis with as relates to using the ATR and then the AUM, whatever that number is, in order to determine our position size for a trade that's going to happen today. And so a lot of people like this. I liked this, my idea, which is kind of like just choosing a number all about the closed equity, let's say, but I don't calculate it daily. So I will, because I want to keep my trade level number kind of constant for as long as possible. I want to not, I want all the trades, all these bets to sort of be the same size and not allow my AUM to have a much of a impact on my edge. So introducing different sizing every day, different AUM level every day is kind of a little bit of an inconsistency, and it kind of can harm your edge that you have because maybe you'll do some you'll have a string of bad trades at a higher equity and a string of good trades at a lower equity, and it'll, maybe minimally cause havoc and not be that helpful. So like I fixed my trade level like last October, and then I started making all this money, and then we'll have all these open trade positions. And now I will change my trade level when I start getting out of most of these open trades. When they start to go flat, I'll say, okay, here's a new line. Here's a new line in the sand. So I started with 1 million last October, and now it's up to 1 million. It hit 1.5, and then now it's down to 1.3. And if all these trades kind of peter out around here, I'll draw a line in the sand and say, now it's 1.3. I'm going to defend 1.3. I'm going to be very nervous if I go below 1.3. But if I'm above 1.3, I'm going to let my profits run. If I get to 1.2, I'm probably going to change it to 1.2. I'm going to take this cutback, reduce my positions, reduce future trades, and make that the line in the sand. I was premature, or I need to preserve this capital, and I'm defining this capital as original equity plus some of my closed out, or maybe all of my closed out profit. But it's not like a precise game. It's just trying to recognize the benefit of taking small losses and preserving capital, but we have to redefine capital every now and then. Every day, I don't like that. But every now and then, redefine what our capital is. In order to perfectly eliminate this problem, it's not really a problem, we just made a bunch of money. One could say, I've got 5 billion under management. I'm going, at the end of each year, I'm going to redistribute those profits and keep my trade level a constant 5 billion all the time. And okay, then you've eliminated some clients, and you've eliminated this random thing of how we're trying to build our business. We're trying to grow our assets. We don't want to give the money back, but we do want to take into consideration that some of this open profit, if it's a lot of open profit, it's not healthy and safe to incorporate that into our trade level.
Hi, Jerry. Hi, everyone. Look, I just wanted to say I'm giving this another shot at taping via Clubhouse. They're quite crafty in how they try and prevent this, but I think I've got a little workaround now by using my wife's telephone as well as mine. Anyway, Jerry, I totally agree with you in a more conservative approach to this leverage that we're talking about. So when we say closed equity balance, I sort of use the term realized balance, but it's the same deal. And then when you say, yes, well, maybe we should also be looking at our unrealized drawdowns on top of that realized balance, because at the state of taking your trades, if you are in that situation, particularly on the early years when you start your fund up or your portfolio up, you do sometimes find that your unrealized equity drops below your realized balance or your closed equity. But with positive skew over the course of time, that flips and you get this extreme positive skew where the problem doesn't persist. But especially in the early years of starting up a fund, a more conservative approach is to say, let's use my realized balance plus any unrealized drawdown, which is not including the unrealized equity or the positive equity. It's just looking at the drawdown component. So at the most conservative level, you're then applying things such as position sizing, etc., on the most conservative balance that you have at that point in time. And then maybe you only compound monthly as opposed to every day you do that calculation, because what you find if you aggressively, particularly with the classic trend following funds that build up this significant equity, you find that it can actually build in significant leverage into your models so that you get this pogo stick effect that you might see with Paul Mulvaney's fund, where he's got to a position now where each month we can get a magnificent uplift or a magnificent downside volatility range because there's this aggressive compounding going on. And I think to keep, at least to stop the ulcers developing, you need to be much more conservative in the application of lifting your position size.
Yes, I like that. And I think compounding is something that we need to be careful with. And and another thing that I would do as well is I'm going to be very careful moving my trade level up, as I've already described, but not so to move it down. So I don't want to move it at all. So I want to have a great system, a lot of diversification, trade small, and not have to decrease my trade level. But if I have to, so if I go 10% below my trade level, then I might consider a 10% cutback across the positions and across the new trades. And then once I build up I used to have this big dilemma on these cutbacks. When do I go back to my previous trade level? Well, I think what I came to this conclusion is that you don't go back to the previous trade level. You keep cutting back if you're continuing to lose your capital. But what you do is when you once again have this big run and this big buildup of open trade profit, you then reset it again. You don't have to remember, well, where was my previous trade level. You do the same thing that I'm waiting on now. I'm waiting for all these great trades to turn flat and have very little open trade equity, and then I'll move it up. I'll move it up, and I'll claim that new level of closed trade equity, realized equity, as my new benchmark, and defend that like I would this initial $1 million that I got in 1988.
Hi to everyone. Very glad to be here as always. I want to say that my opinion is that this topic is very important for all of us because this topic is a part, for me personally, it's a part of our risk management rules. So if we are talking about risk management rules, we always must be very careful. And I like very much what Jerry says about this.
For me, I think, like Oleg said, it is important, but I do it in a more systematic manner. I like to adjust my positions, or depending on however you measure it, whether that's through the AUM or through your capital or however you're measuring it, only if it's going to change the position of my trade by position size by 10%, because I'm still risking the same amount. And like Jerry had mentioned, it does affect you if you have bigger positions and you're losing, and then just because of how returns work, coming back from the drawdown is going to be harder to recover. So it works both on the way down and on the way up. I don't think that a 10% change in the position is too little, where you're changing it every day and then you've got all these different positions with potentially different results. It gives you that kind of level of stability, but also a clear mark in the sand that I know when this happens, I follow my rule and I can just adjust up or down.
Just one final comment from me, and then I'll shut up. I was wondering, and maybe this question could be posed to Jerry, because I know your fund kind of shifted more toward the commodity space in lieu of bonds. Could be, correct me if I'm wrong on that, but there was a kind of a strategic shift that took place. Was that in sort of anticipation of bonds kind of entering this, low interest kind of range bound space? And then the second question is, for those trading individual equities, by nature of trading the most liquid names, you are capturing, a lot of equity beta, compared to, say, SPY or the common benchmarks that one might use to assess the efficacy of the strategy as a diversifier. So, but then again, you're capturing additional diversification. So how do you balance those things in kind of shifting your overall strategy? I know we're talking more specifically, but that was my question.
Well, I would never try to anticipate some sort. I don't really believe that it's. I read this all the time, but I don't have any idea about the regime change and anything fundamental. So nothing from the news or from fundamentals, zero. So I just made an adjustment once because, well, I used to trade, 50 bond markets, but they're way too correlated. They all look the same. And so the commodities, I trade 50 commodities, but they don't look the same. Some of them do, but most of them don't. So I think if you're going to be serious about uh, what's in your portfolio and the weightings in your portfolio is only based upon the amount of diversification each individual market gives you, then you're going to trade a lot of commodities. Now, I know that a lot of people don't agree with that, but that's just the way I approached it. Like, I'm the king of don't pay attention to your volatility of your open trades, but it doesn't mean that I don't try to minimize that by being as perfectly diverse as possible. And I'm not in favor necessarily of trading the most liquid stocks. I am just in favor of trading uh, stocks that are very liquid or liquid enough for my system and my AUM. So I wouldn't. I would do the same thing. I would do an analysis, and this is where it becomes a little difficult because in the commodities, it's not as there's 50, so it doesn't take a lot of analysis. And um, but in the stocks, there's 5,000, so you've got to figure out a way to to get a hold of this beast and figure out which 50 or 20 you want to trade, and hopefully you get some diversification. But I'm dead against trading a lot of stocks that look like the S&P. That's no good. That's giving you the S&P. Trade Microsoft. Okay, you're done. That's your S&P. You're okay. You trade that one, and then trade Beyond Meat and Canopy Growth and Tesla and things that are different. However, I've said as well, I've sort of changed my mind on this, is that I really don't try to have a perfectly diversified portfolio. I just try to do a pretty good job of being diverse and understanding that I'm going to trade heating oil, unleaded, and crude because even though they're highly correlated, because sometimes I've seen heating oil double and crudes kind of sit there, and that happened in silver as well. So sometimes you're trying to find the outlier, this crazy thing that's never happened or doesn't happen very often, and sometimes uh, one of the group of this highly correlated group will have a big outlier and the rest won't. So I like diversification, but I'm going to try to accept it the way it is, and that it's not perfect, and I don't want it to be perfect.
That's great. So it is sort of an ongoing assessment of sort of correlation and liquidity, balancing the two, as opposed to macroeconomic predictions and whatnot. Thanks for that.
I don't think it's as much ongoing as you would think. I'm not doing too much ongoing. I'm not looking at my parameters ongoing. I'm happy with them. I've looked at 40 years worth of data. I'm good. Let's just keep these parameters where they are, medium to long term. And so probably I would be very slow to change a stock and just say, yeah, I'm not in favor of ongoing. Anything that's kind of, once again, I'm making these changes and I'm adapting and I'm using recent data for something. That's a big no-no for me. I want to keep things simple and constant, if at all possible. And once again, I really think that this trade level question is an opportunity to say, to understand the value in keeping things the same. I don't see it very much. I think it's a little bit different, but it does remind me a bit of, I'm going to change the unit size in the British pound because of recent performance. Because I'm going to trade the pound twice as large today that I did last year because of whatever. So I don't want to do that, and I don't want to change my trade level very often either. Changing the trade level is necessary, but it eats at your edge. It can randomize your edge a little bit.
I want to say the words of Niels from Systematic Investor Service from my notes. And Niels said that when decide what markets to trade, use common sense, not too many markets in one sector, and have a diversified portfolio. I like this word. And I think that if we trade, of course, if we trade silver and platinum, we have a very big correlation of silver and gold, and it's very high correlation between these instruments, but we have exceptions, of course, but I think it must not be equal. I mean, if we have, for example, a $1,000 per trade risk in silver and $1,000 risk per trade in gold, it's not the right decision. I think it will be better to have $500 for silver and $500 for gold. I think so.
Actually, I think that brings up a good point. Do you guys cap the amount of positions you take in any sector or any asset class? Because trends can trigger. I mean, maybe they won't all trigger on the same day, but you might have a bunch of your energies going off at the same time, or you might have all of your equity indices, especially if they're developed markets. That could be another way where correlation sneaks up on you because we're getting one of these kind of outsized moves and things are maybe moving up or down together, and that could kind of overload your the normal correlation.
Very good question. So, no, I want to be a slave to doing the trades the way the system does the trades. On the day that it breaks out, I'm going to do the trade. I trade multiple systems. They're all breakout, so they can all signal on the same day. I got no diversification, and on the exits as well. And then, just like you say, everything in the sector, or a lot of things in the same currencies or whatever, they can all break out almost on the same day. But I think I'm going to try to handle that up front with my fixed universe of markets and my fixed portfolio weightings in a way that says, yeah, I'm not going to be happy about this if it happens, but I'm going to do all I can to do the trades when the system says to do the trades in the way the system says to do them, and not have this money management scheme idea that, but if something happens crazy, I don't want to have all that risk on the same day. So I'm not ruling that out in an extreme situation, but I think as a system trader, you would hope that you wouldn't have to do that. Yeah, so I lost my train of thought, but very good, very good question.
I want to say something about extreme situation, and I want to say about the crisis environments that we faced in 2008 and in 2020. And Niels said very good thing that if you trade commodities, it will stabilize your portfolio and it will help your portfolio very much. In fact, it's a very good idea to trade commodities. I want to say this. It's very good diversification because commodities showed very good performance in all crises. Niels said that. I'm very thankful.
Oh, I know what I did. The other day, I went through my portfolio and all my systems, and I went sector by sector, and I calculated the dates I got into each of the positions, and the distance between the dates. So, what was my longest held position in the currencies, my second longest, my third longest, and so I just sort of subtracted the days, and then to see on average, like how often do I get in things at the same day, and then on average how far they spread apart. And so it was pretty darn good, that it was spread out quite a bit. So I think, I do think I've tried to come up with different schemes over the years, and I would become very uptight about having to put all the energy on at the same time. 2012, I had a below average year, and I kind of blamed it all on the choppiness of these energy markets and having to buy heating oil, unleaded and crude, and then sell them all, go short on right around the same time and do it multiple times. And I thought, yeah, I got to figure out a way to minimize that. But then I sort of thought, well, I think the problem I had was trading the energies too large, trading too large to begin with, probably, and then trading too many energies because they are kind of similar. So, and then I just saw the merits. So I'm looking at some of the back test of the computer will really penalize you if you are not consistent and trying to figure out a way to exercise this contemporaneous money management scheme and risk control by going against the system signals over the long run will lower your performance.
No, I remember that energy market. I mean, I think that on the flip side, it can also be really beneficial because there is always the chance that the sector runs, and then you're really able to have, like it will rarely be on all the same day. They'll have slightly different entries. They might be affected by whatever macro news or whatever people are doing at different rates. But if they're all running, then you really do get a nice bump in performance. And since we know what our system does on the individual basis, it could have also worked the other way if it wasn't kind of the whipsaw environment.
Hi, guys. I have one question about this. Don't you think, on the other hand, that using the open equity is it could be dangerous in terms of risk, but it's very it's very robust since it updates itself and the rule is very simple. And the other question is, what do you think about using correlation matrix to size positions?
Okay, I'll take a stab at the two parts. I think that if you just use the total open trade profit, total equity, it will be relatively similar, but potentially overstating
could be another
the more risky riskness. So if you just use the closed trade or the realized performance, you'll have slightly smaller position sizes. But in general, you'll be relatively close to where you were, only by the difference in percentage of how many open trades profits you have versus your total realized capital. On the correlation side of things, obviously we are trying to improve our portfolios by having more correlation. If you think about it in a way that the more uncorrelated things are, the more risk you can take. That is kind of true. There is a lot of academic literature about that. But we also know that correlation becomes polarized in extreme market situations. So modeling that can be quite difficult because you don't know what situation you are. You want to try to keep things simple. If the correlations go to +1 or -1 on whatever you're holding, you might be, in fact, over-leveraged in those moments, and that could cause some problems.
Thanks, Derek, because I was thinking about that because of the comment that Jerry said about the energies being too correlated, and I was thinking, what if you put something systematic to take care of that issue? And I see some CTAs that do that. And my comment about the open and closed equity is of the same line. Like if you trade your open equity, then you don't have to select parameters like how many months until you resize your trades, etc.
Yeah, the only thing I dislike about using open trade equity is that the positions could be very different. I like to have the same bets. Let's have the same size bet on for a while, because my later trades may be better than my first few trades, and vice versa. So I have an edge, but if I get unlucky, I will have made money on most of my trades, but lost money for my clients because, unfortunately, the ones that were the losers, I had the highest trade level. So I'm just saying you're introducing this random factor into a solid scientific edge. Now, on the correlation idea, I want my fixed unit size, my fixed weight. I don't want to change that. I'm setting that up before I start trading. then I start implementing British pound is going to be a normal unit size, an equal weight. I'm going to say, I'm going to use the correlation matrix to sort of determine that, well, palladium is not. Palladium is going to be twice normal. Nothing's correlated with it. Nothing's correlated with sugar and Tesla, and nothing's correlated with Bitcoin. So I'm going to fix those unit sizes, fix those weights. They're systematic. They're not done. They're not changed daily. They're not subject to change over time. And once again, you could say, okay, that's great. You started in 1988. A lot has changed since 1988. Do you still think this certain market deserves an equal weighting? I get it. Yeah, I agree with that. You may have to change after a lot of evidence to say, palladium is moved just like the other metals now. It's not different. It's very similar to everything else. And so I'm going to make this change from an overweight fixed unit size to a normal weighted unit size. And so, okay, and hopefully I can hang with that for a few years. I'm just not, I'm into systematic, just not daily. This is like this change. I'm not changing my ATR calculation daily. How I'm using 15 days sometimes, and I'll use 20 days another time. And I'll make that decision and try to stick with it for a long period of time. So I'm not against change, just this daily recalculation of, because I want to do everything the same for the rest of my life. I'm going to do the same entry, the same exit, the same unit size, the same trade level calculation, try to have on the same bets as much as I can. It's a great problem to have. You make a lot of money, now you got to absorb those profits into your trade level. What a dilemma.
Yes, and on the size of the stops, or the size of the R, what's good? It's something that I think Richard said. It's a way to keep cleaning your capital in search for the next good trade. So that's great if it also is the same size, because it liberates capital on the same frequency, so to speak. If trades go wrong.
Jerry, have you tried to look at clustering algorithms as opposed to measuring correlation to do exactly what you're saying? So in other words, every so often, I don't know, every time you feel comfortable with, monthly or quarterly, whatever it is, just look at how your different underlines cluster around each other and spot obvious changes. So for example, bonds now are moving, opposite to stocks or the other way around. And certain commodities move away, certain others move another way, and then based on that, do your introduce your corrective factors. So in that way, you could add some systematic process around your thinking of recalibrating your systems, but not at every turn of the market.
Like I said, I got very interested in trying to measure these correlations very precisely, and then and try to have this perfect portfolio so I could really not have to worry about the volatility and the open trade equity and let my profits run. But I sort of abandoned that idea because I feel like I would have to make too many changes. And I think that our bottom line is not a portfolio that is is perfect as it relates to volatility, and we have great weightings to where our correlations are minimized. Our bottom line is to capture these outliers. And if that means we have to have a little bit more correlation amongst the portfolio instruments, then so be it. But I'm not going to kick out or trade some of the markets smaller because they're correlated, because it's not the same thing. It has a different name. And so it's definitely possible for the harbor in New York City to freeze and you can't get the heating oil in. And it could only happen once every 10 years, but I'm going to trade heating oil and unleaded and crude the same size because I know that these outliers can happen. And that's what I'm going to sell out for, not I appreciate the diversification. I appreciate when there's not diversification and I'm losing 3 times the money and energy that I would in another market. But that's the price to pay to capture heating oil like we did in 1984 and 1990. It literally had an outlier move, and the other two did not.
Look, on the correlation, I've got real issues with using correlation, because when you use a single statistic, such as the Pearson correlation coefficient, let's say we've got return streams over a 20-year duration, and we're looking at the relative movement between return streams. Over a 20-year period, you can have times where the two return streams are perfectly positively correlated, and then at other times during adverse conditions, they're negatively correlated. And the result at the end of that is a Pearson correlation coefficient that says they're uncorrelated. But clearly, the regimes during the different environments of the 20-year period create this significant positive correlation, and they might create this significant negative correlation, or there might be this period of zero correlation. But the single statistic will lead us astray in assuming that they're uncorrelated, when in fact there are certain times when they're very correlated or they're very uncorrelated. And the problem with using correlation as a means for position sizing, etc., is that let's go back to 2020 in March, where everything in February, everything was fairly uncorrelated, and everyone was loading up their portfolios because all their markets seemed to be uncorrelated. But as soon as March 2020 hit, all of those markets across commodities, everything, they all started going south together, and they were almost perfectly positively correlated in the adverse direction. So that therefore leads you to excessive risk exposure if you're looking at a single statistic like that. You really need to look at the entire path and how the return streams move in concert with each other. And so I really like what Jerry's saying is simply apply a standard bet size per market. Don't infer that correlation can give you an extra edge, because what it really does is it can also give you, extra risk.
I have specifically looked at clustering algorithms for estimating correlations because of what Richard said. Correlations are unstable. They're hard to make an estimate of. And especially when you're making estimates of correlation because of how the formula works, you actually have to invert the correlation, and then any error you have actually grows exponentially. So I don't know if you've read Marco Lopez de Prado's work on hierarchical risk parity, which reduces the error of correlation estimation through machine learning and doing clustering. Actually does like a tree formation. I found that if you already have a high level of diversification in your portfolio and those things are generally stably uncorrelated, then it doesn't really give you that much of an edge. But it adds a significant amount of overhead and complexity. I mean, I'm talking like 0.1 sharp, 0.2 sharp. But if you are talking about trading a single asset class, where like equities, for example, like single stock equities, and they do tend to have these types of like undulating correlations with the market or their beta, then it does help you a lot more. But in the traditional CTA pure trend following sense, I think it adds quite a lot of complexity for not that much additional performance power.
And thinking about Richard's eye-opening statement that he made a while back about stop losses are not as important to us as risk control as our small positions are. I'd say the same thing about correlations. The small positions that we have, if we can trade a lot of markets and each position can be really small, if we blow the correlation and we get it kind of wrong, it's probably not going to matter as much. That's why I'm so adamant about adding more markets. And I'm up to almost 125, and some of these crazy small commodity markets, they're different. And it allows me to trade everything else a little bit smaller to where it becomes irrelevant when you look at the whole as to whether I've got the correlations perfect. My energy trades now are so much smaller than they were when I was complaining about that energy collapse, I think in 18 or so. I was so mad about that. And really, it was, just me overtrading energies, I think. And then we all know the stocks are correlated, and they were all correlated last year. And so take that into consideration and use that information when you're setting your total risk. What's my total risk? Because all of these markets can become correlated pretty quickly. So what's your maximum risk in your portfolio? And what's your maximum risk per sector? Commodities are not as correlated, let's say, usually as stocks. They don't all go to one like stocks can, but they might. And so I'm going to make sure I'm happy before I start trading with my sector maxes in currencies, commodities, and stocks and interest rates. And then, because what happens is the stocks were all correlated last year, and then ever since then, they're back to not being so correlated. So what are you going to do? Suck it up and sit there as best you can. But the key to getting this right is getting it right before you start trading, not during. It's not going to work as well. And then it's a discretionary move to make these changes during periods of time. Once in a while, discretionary move to dramatically reduce your risk and stay alive, perfectly acceptable. But frequent discretionary moves, trying to claim them as system and new analysis, I don't like it. I don't care if it is analysis. I don't care if it is a rule. It's too frequent, and it's based upon a short-term data. And then my last point, when you overlay the trend following over top of the markets, the correlated markets become less correlated. Maybe not enough, but there is some differences. I bet you my correlation to my euro position compared to Swedish krona and Norwegian krona are very, very high. But right now, I'm long euro and short Norway. So, but the correlations are high, but my positions are opposite. So you have to take that in consideration. Sometimes we get bailed out on our trend following, by our trend following.
Hi everyone. I'd like to second this last point from Jerry. One thing is to evaluate the correlations of the assets. A different thing that's I believe it's more relevant is to evaluate the correlation of the P&L from. Can you guys hear me?
Yes, keep going. Sorry.
Okay. As I was saying, I think it's more important to evaluate the correlations as if the position on that asset from a trend following perspective was a different asset itself. And the second thing is these correlation analysis. I find it pretty hard to trust them, because the moment we most need these correlation buffers to work is the time that all correlations go to one, as Jerry said. So are you really sure that correlation is high or low? Can you trust it when you most need it? I can't say so. I take a much more heuristic. I think heuristics can help you much more. Try to think about what goes together. Do currencies go together? Then this is a cluster. Do energies go together? And then this is another different cluster. But within this cluster, it's pretty hard to say what is what. So I do prefer to go all equal weights on these guys, and that's it.
I like your words, Bruno. I think that all financial instruments, all financial stocks, bonds, currencies are very high correlated instruments potentially. And when we face the crisis, we see this situation. So, as I said before, as Niels said, of course, and Jerry said, and Maurice in Systematic Investor Service, and in different interviews, that we must trade fully diversified portfolio. We must have commodities in our portfolio. It's very critical.
Just to add on that point as well, I think with correlation, what Rich said, I think is quite key, just because it's not a static thing, and to treat correlation as kind of a static measure is quite problematic. But also, I think the importance of correlation is overstated when we talk about it in the context of trend following, because I think it's far more relevant in the context of momentum style trading. And again, I think Rich's piece on kind of identifying an edge was really eye-opening in this context, because what it shows is that what we may perceive to be a trend is actually more of a momentum move. And in fact, I really like Jerry's use of the word outlier, because that's kind of what we're looking for, the extreme uncoordinated moves that kind of we can see in hindsight, but we may not be able to tell in that moment. And I think in that context, what we'll see is that because these trends come in all different kind of forms and durations, I don't think correlation is as relevant in that context as it would be to momentum style trading.
That's a good point, Izzy. I'd agree with that, and I'd say that we've got to be careful that we don't place too much emphasis on correlation when really it's the outliers we're seeking. And correlation, and this discussion on correlation is more a discussion about risk management. And we've seen that there is a weakness in using correlation as our savior for risk management. We might be able to use a term called co-integration to a degree, which is a more stationary relationship between return streams. But correlation itself, I think, is a bit of an illusion and can get us into big trouble.
Yeah, and on the point about the open P&L versus kind of realized profit point as well, I think the key aim of trend followers is, I think it's Jerry's phrase, is to stay in the game and preserve your capital. So what we'll find when we're using open P&Ls is that your capital, and given the amount of time that a trend follower will stay in drawdown, you'd find that your kind of capital, the trading capital deteriorates rapidly, in which case you may need to take more extreme measures, for example, dropping the size of the position. So I think rather than focusing on aspects like correlation, it's probably more pertinent to focus on kind of other risk protection measures, like reducing capital size, trading more markets.
Yeah, I like that. And what Bruno was saying about it made me think about actually the trades. What's going on in these trades. I have basically been almost a 100% long, for a long time now, and so all of these markets are going up: currencies, commodities, stocks, and so there could be a high correlation. But now that some start selling off, my P&L and some will be vastly different. So even within the energy sector, I may do my overlay of the trend following systems with the different look backs. One system might have a big profit and the other may have a loss. And crude could be a much bigger position, much bigger profit than heating oil, just because of my exits in each. So I think I look at my P&Ls and they don't seem to be nearly as correlated as using a traditional correlation matrix. But even in good times, I don't want to use like Bruno was talking about bad times. Yeah, in bad times everything goes to one. I definitely don't want to use get overwhelmed and fall in love with correlation. I'm going to really be happy that I said, my biggest idea here was to trade small. My max risk is something I can handle when everything goes to one. And then I'll have another rule that says the max risk needs to be reduced. I need to reduce some positions like I did last March and February. So I think another thing I wanted to mention was this open trade, equity. And I was talking to Niels yesterday, and I was like, the whole goal here is to do whatever we can to let these profits run. Right? I mean, that's the whole key. That's who makes the most money, is people who don't get out too quickly. I feel like I can take these small losses and I'm going to risk 25 basis points or 50 basis points per trade. Okay, it's pretty darn easy once you have 30 years behind you. You're not really that happy about holding on to these losing positions, anyways. But everybody is going to struggle with these mega profits. And what do? You don't want to give them back. Iron ore is selling off. What are you going to do? You're going to hold in there? You're going to hang in there with your iron ore? Maybe it'll go a lot further. But I think that if we're asked to defend our capital, and that allows us to let these profits run and to use robust systems and a very few parameters. If we're trying to preserve the total equity that we had, then it's impossible. We're going to have to add in variables. We're going to have multiple exits. That's a big no-no. Each system can have multiple exits. You already have two, your trailing stop and your stop loss. Well, I'm going to have another exit that allows me not to give back so much profit. All right, then you've just weakened your system. You're going to add profit objectives. You're going to add vol targeting, more variables, because I have to defend my total equity. It's impossible. You can do it. People do it. They're very successful. They have the most AUM from clients, of course, because clients don't like to see these profits go away either. But if you're trying to defend a closed trade, a realized trade level, then it becomes much easier to do the right things on a daily basis, following your system, and then creating the better system.
Jerry, on that point, I just had a question. Would you say the same applies? Obviously, you're trading 125 markets, but would you say that holds true for someone trading, let's say, 30 markets? Only because I imagine with 125 markets, even without kind of system diversification, you probably capture enough trends to make a significant amount of profit. Whereas someone trading only 30 markets, if they're not also diversified in the systems they use, then if they're not able to capture one trend in one market because they get stopped out, the impact on their overall P&L will be much more significant than, let's say, someone who trades 125 markets.
Honestly, I don't think it would be a great deal of difference in the long run. I guess I'm not following your point, but if I was trading 30 markets, I would trade a couple of grains, a couple of currencies, some stocks, and energy, and just have this same diverse portfolio, but it would just be fewer markets. And I would just have to hope that my couple of currencies, they did as well as the group of currencies for someone who trades over 100 markets. And the same with, if I just traded wheat, corn, and soybeans, I'd miss out on the bean oil because that's been the real good one, and canola and Malaysian palm oil. But and maybe copper's been the better of the LME metals. So it's just over short periods you may do a lot better or a lot worse, but over a long period of time, I think you would make about the same amount of money if you're only trading 30 markets versus over 100. I think you run into problems if you can't take all of the trades. And this is getting into Seth's question, like, what do you do if you're trading cash with no leverage and you can't take all the trades? Then what do you do? How do you skip trades when you have too many trades to do and you don't have enough cash to do them? Do you cut back all the other trades? I think that's a tough dilemma. I've always traded with leverage. I can get leverage with my stocks. It's like 6-to-1 at IB, 2-to-1 at every place else. There are so many ETFs that I could trade that would give me diversification: commodity ETFs, currency and bond ETFs, stocks. I thought you could do partial positions in stocks, or I didn't think it would be very difficult to have a diversified portfolio and be able to take on enough trading and to take all the trades. But maybe I'm wrong about that. I've never done it. But I definitely think that one of the keys to proper trading, is doing all the trades as they come and then the portfolio risk can expand and contract as your opportunities come and go. So, but I think using leverage is kind of a must. You can't skip trades. You can't just randomly decide which trades you're going to take. I think that's a bad idea.
Thank you, Jerry. A couple weeks ago, I had asked about philosophy and whether or not your philosophy influences your trading style or vice versa. And I think it was the week after that, you pretty much said the same thing. You know, always be in the market and never miss a trading day. And I want to say thank you for that, because every day I don't use the kind of setups to where I would have a trade every day. But what I've learned over being in the market, even when there isn't a setup, and just waiting for it, is that I cannot anticipate when the trade is going to come. I think it was Tom Basso posted a awesome trend yesterday to Twitter, and I've gotten used to using the bell curve. Of course, not everything moves in a normal distribution, but when it does, the way I see it is it creates levels that I could apply from the left side and just apply it to the right. So the probability of price coming back to those levels in the same way that they did on the left side of the bell curve is highly probable. And I've been using that, and what I've noticed is that from a trend following perspective, the risk aspect of it is mitigated under the conditions. So in other words, it's the conditions first, like what kind of market it is, who are the buyers and sellers, what kind of buyers and sellers there are. I don't know this for a fact, but I highly doubt if someone trading a $100,000 portfolio is going to come down to a 5-minute time frame and trade that, or he's going to trade it with different size. But the conditions are created by the buyers and sellers, and in looking at the conditions and looking at the kind of money that comes in and what kind of trends are created from capital size, initiating positions, the whole nine, I realized that my risk to ruin is 0%. I finally gotten to a point to where I can actually say that, because for me it was really, I literally couldn't do the math because my emotions were in the way. So I never considered the long term, because I was always so concerned about making a profit that day. But now it's I could watch price move a couple dollars and it not bother me. So I just want to say thank you for your advice, and thank you for this group, because it's really helped me in my trading. So thanks.
Thank you, Daquan. Seth, how are we doing answering your question?
Hey, Jerry. So maybe I can give a little color and a little background to why I was asking. My primary research focus lately has been in applying trend following to the crypto markets. And there are thousands upon thousands of cryptos that are available to trade. And I'm trying to get my head around the best way to approach building a portfolio, building a watch list, because I want the greatest opportunity to catch the outliers. And I think that probably comes not from focusing on the top market cap weighted tokens. It's probably looking more at smaller market cap tokens. And the good thing about the crypto markets is that you can take fractional positions, so you can take very small positions. So leverage isn't really needed, especially with how high the volatility is in almost all the space. So I'm just trying to work through it, and as I trade, and I've already found that even trading multiple times, I've already kind of run out of cash with only 12 positions. And I guess the easy answer is to just reduce risk per trade. But I know that there are some people who do this, who do cash equity. So I was just seeing if anyone who wasn't using leverage trading cash equities had some recommendations for how they handle it.
Yeah, definitely. I would reduce positions, and so I could potentially have every trade on, but since you're going to base the size of those trades on the volatility, the ATR at the time, you don't really know exactly. You're not going to get it perfect. But one thing that I have friends who love crypto, and I trade Bitcoin futures, and I'll trade Ethereum futures. On the next trade, I'm going to reduce my unit size for Bitcoin and add Ethereum and trade, move some of that Bitcoin risk to Ethereum. But one of the things that I sort of heard in your description was when people come to me and they say, you should do a fund with crypto and trend follow crypto. One of the things that I would do, and I don't know if this is how you've approached it, is that I would use the same systems I use now, and I would not do a back test based upon crypto. And so that's just me being me, because I'm going to let's say I had no data for crypto whatsoever. It just started, and I want to trend follow Bitcoin, which is what I basically had to do, and then, or I wanted to trend follow a group of cryptos. I would just say, okay, I'm going to go back and look at my currency, commodities, stock, bond, back test, and those are my systems. And when Bitcoin comes along and the cryptos, I'll throw those in as well. Okay, I'll throw the crypto data in. And then you'll say, well, that's not going to make you change your systems, because it's just 10 new markets or 20 new markets versus over 100. It's not going to move the dial very much. You're not going to have a crypto based systematic approach. Darn right I'm not. I'm using all the data. What's worked? All these markets are the same. We're trading them the same. They're going to have the same expectation per trade over the next 100 years. Maybe not in the back test, but eventually they'll all start looking exactly the same. That's our theory. That's our philosophy. That's how we get our sample size.
There's one big differentiator I see with crypto that doesn't apply to most other traditional markets, except maybe cash, forex, and the fact that the market never closes. I think it's just from my initial bit of research, it's easier to use kind of a resting stop with crypto. You don't have the gap risk. But otherwise, yeah, I'm using very similar parameters that I trade futures with to trade, for entry and exit signals. But yeah, I was hoping that Mike Melisinos might chime in. I know he does a lot with cash equities, and has used a little bit of maybe, can we say, flair in how he chooses his markets that he trades.
I know. I don't know where he is. He's not speaking today. I had to boot him off the stage because his mic was on. But I know in the early days of Clubhouse, I was in a small room with him, and we were chatting, and like 30 minutes later, he's like, dude, you got to get off. I can still hear you talking to your wife. So you got to be careful with that mic and staying in the room, but not and thinking you're out of the room. So anyways, maybe we can shame him to come back up and give him some of his wisdom. Yes, we need some mic wisdom.
Richard, I know you commented on my Twitter thread. I'm not aware or not, do you trade cash equities? I know like Nick Raj down in Australia does a lot with cash equities, and I feel like there has to be. I just personally, I don't know that picking a fixed universe to just watch in perpetuity is a great idea, especially in crypto with how emerging technology is and how quickly a new token or protocol can be introduced and becomes very quickly popular. It seems like you have to have some kind of flexibility in allowing new markets into the portfolio, at least to watch, not necessarily trading every new thing, but at least having some way of letting new stuff in and maybe kicking out old stuff that becomes redundant or out of favor.
Yes, Seth. Look, you might all have to close your ears because I actually trade CFDs and Forex. So in my world, I get a similar exposure across asset classes using these leveraged instruments, and I'm a big believer in you need this leverage, but I'm prepared to pay a slightly higher material cost on the transaction costs within my universe. So my CFDs go across the commodities, the bonds, all of these different things. That you'll get the same exposure in ETFs and futures markets, but within my world, when I'm trading Bitcoin and the cryptos, I'm actually trading CFDs. So I can get very small scale bet sizes. So I get very wide diversification because in my universe, in the retail world, you can get very small bet sizes. And just on that, Seth, you were saying that you might only be able to trade 10 cryptos, but in my world, I could trade them in exactly the same way as all of my other leveraged instruments, my CFDs. And so I seek to scale down the bet size to the minimum possible bet size I can get on my instruments, that therefore increases my diversification. And the reason I do that is that because I'm targeting these outliers, when I look at the trade distribution of returns, I'm talking about 5 or 6 or 7% of my total trades are the things that make my day. They're the non-linear things. And the reason why I scale down everything to the minimum size is that it becomes scale independent when you look at the materiality of the outliers versus the materiality of the 95% of the other trades. They're effectively linear. The relationship with those 95% is they're linear, and that creates this sort of random equity curve. But when I hit those outliers, it might be they're so significantly material to my P&L that no matter what scale I reduce my bet size to, I still get the big benefit of those outliers. So my philosophy is get as small as you can with the bet size to reduce the churn of the market or the churn of your equity curve, so that you still can capitalize on the magnitude of those outliers, even though you've got a very small bet size applied every time you place your bet, if that makes any sense. I hope it does.
I do trade crypto. I use futures because, again, like Jerry said, it follows the same systems and the same rules and the same backtest style that would apply in traditional markets. And I do think that some of that emerging market aspect applies in that they move a lot and the 24 hours, and there's a lot more trend action there. I think that has to do with the types of players that participate in the market, and that has been changing over time. I would hesitate, again, like they said, to customize it specifically. Static, a watch list. Yes, there are more instruments coming in. You need to have a systematic filter to make sure there is the liquidity that you need to get into all of these things. That pretty much prevents me from taking any ICOs, any really small altcoins or things like that, because you don't know what the spread is going to be and you don't know when it's going to move. In regards to your talk about a stop loss, I mean, yes, there should be stop loss in the market, whether that's with your exchange or you're doing it in an automated fashion where you're like, I don't know if you have like an algorithm doing it or you're doing it by hand or however you're working it, but it definitely needs to have risk management on all the time. And I think that that's the same case as you would in the traditional CTA futures space. Talking about the sizing of your cash positions, I think it's less capital efficient, to be honest. If you look at the crypto space, there's a lot of things you can do with that inventory rather than having it sit there all in cash. Cash commissions are usually quite expensive, and if you're trading those altcoins, they can crash, and then your whole inventory is gone. You need to unload the whole thing, as opposed to the futures markets and the perpetual swap markets, which are really extremely liquid. and sometimes have commission sizes around 10 basis points, whether spot is maybe like 25 basis points. So you would end up actually saving money using the derivatives, getting your leverage and being able to put on all your positions, than actually doing the spot version, holding your inventory, having to have a cold wallet, managing that, putting that on and off the exchange, instead of just trading the paper product.
I thought it was funny this week that the SEC commissioner came out and said something like, well, I will allow a Bitcoin ETF to exist if it's futures only, but not actual Bitcoin cash or whatever you call it. I'm not against, you want to have this fixed universe of markets, but then it has to change as you add new markets. And then some markets go away, like you were saying, Seth, and then you have to get rid of those. And so you have this maximum risk you're willing to take, and you split it up between these markets. And maybe if you have 100 markets, you can trade a little bit more maximum risk than if you had 50 markets. But usually if you're continuing to add markets, you're going to keep this max risk about the same, so you're going to trade everything else less. This does introduce some inconsistency in your behavior. Now I'm trading everything a little bit smaller. Okay, that's fine, but you're not doing this daily, and it's every now and then, and you're doing it when it becomes kind of more material, let's say. So I think, you want this desire for everything to be the same for the rest of your life, but then things are getting better with more and more markets. I started out trading 20 markets, and I traded them with maybe a similar maximum risk that I use today. But now I'm trading 100 markets, and I'm trading all those original 20s very small, because they're fitting into my maximum risk. So I'm not against doing that, but I think we just see all the time specialization gets punished, whether it's crypto only, it's just going to end in a disaster. Commodities only is going to end in disaster. I mean, for most people. I was listening to a podcast yesterday from Talking Hedge. I posted it on Twitter, and they were talking about commodities and CTAs. And one of the institutional investors was saying, like, there's just not many fundamental discretionary commodity traders left. They've all gone out of business. Well, number one, they didn't use trend following. They didn't go short. And then they only traded commodities. And that's, and some very talented, successful people who made hundreds of millions of dollars over the years, got out of the commodity business because of losses, because right before the commodities got great. And I think the temptation to lessen the diversification is something that, for most normal humans, is going to lead us to a really bad spot with drawdowns in particular.
Jerry, but when in the transition from 20 markets to 80 markets, for example, since in trend following we are after that big outlier and you reduce your risk per trade so much, the positive outcome is that trends tend to be on the whole sectors, or how do you retain that big advantage of having one outlier, say heating oil, when you just had 20 assets versus having a small heating oil trend today? Is it because there is a contagion on the whole sector, or because there are more trades that keeps being the same as profitable as in the past?
I think each individual market has the same expectation and the same possibility of an outlier trade. And I was listening to a podcast a few months ago, and someone said, there is a cost to adding markets, and there's absolutely not. And they misspoke. They said, you're only going to get 5 or 10 of these outliers per year. And I was like, no, you're going to get 5 to 10%. I don't think that there's certainly nothing theoretically about trend following that should give you any indication that you can pick these outliers. And so, yeah, exactly. If you have you're going to miss some of them, and if they're not in your portfolio. And then if they are in your portfolio and you only trade 20 markets, the impact of that outlier is going to be, and you happen to get the right one, you happen to guess correctly, yeah, it's going to be a bigger impact. But one of the things we have to remember is all of these markets have the same average trade. That's our fundamental belief, and that they all have the same opportunity over a long period of time for an outlier. And there is nothing to be lost in trading as many markets as possible. If you have a fundamental viewpoint like Buffett in value and you have your top 10 ideas, yes, they'll tell you, why should I use idea number 6? I only use idea number 2, 3, 4, and 5 because I need a bit of diversification. But for us, there is no downside in adding these markets. Now, if you continue to add stock after stock after stock, and so your portfolio becomes overly weighted with stocks that are very similar, then that could be a problem. That's not legitimate adding a new market. That's adding a market that's very similar to other markets. But you can hardly go wrong adding a new commodity. These Chinese commodities, I can't wait to get in there because there's some commodities in China that we don't trade. And then I'm trying to find exposure to lithium, cobalt, coal, water, wind. And so that's leading me into ETFs and stocks. Can I find a company that is highly correlated to coal or wind and water? Probably not as great as trading water futures or coal futures, which kind of don't exist. So we have to be honest about adding these markets and the degree to which they are going to help us.
Thanks.
Yeah, I'd say that
On
sure.
the
After the fact, you will see 5 to 10% of markets outperforming, but before the fact, it's pretty hard to pick up what is what. And I think it's as we've talked on last week, perhaps on trend following, we part from a fundamental point of view that we cannot say what will outperform and what will not. What we do know is that our systems provide the same expectation for each trade, and so we want to take most of them because at least one will outperform and pay the bills for the rest of them.
What we do know in relation to outliers is that most people get it wrong because they're assuming this bell-shaped normal distribution where they think that outliers might only occur, 3 sigma events away from the mean. But we do know that outliers are much more frequent than what a normal distribution would imply. So that gives a bias in the weighting of the frequency of these outliers. They're actually much more common than we feel, and their magnitude is much greater than we believe. So the more you can diversify, the more chance you've got of getting outliers. So the less you diversify, the less chance you've got of getting outliers. So that's because there's this bias in the data where we can never predict when they occur. They are infrequent events, but they are certainly more frequent than what the normal distribution says they're going to be. So, and that's why diversification, we can't say that the more we diversify, the less the marginal benefit. Actually, it's the more we diversify, the greater the benefit, because these nonlinear positive outliers, they're much more frequent if we can diversify.
Like a word much. For me personally, there is 2 main aspects in trend following trading. It's first of all, it's money management, risk management rules, and the second, it's diversification. It's very important to understand.
And I think Richard made a really good point because it kind of fits in with what I was saying earlier, that you can get lulled into thinking 4 or 5 markets of a sector, then I'm kind of covered. Oh, and they're all very liquid. And so I hate the slippage that I get in some of these small commodities. But the fact of the matter is that you're not covered because, you're covered if the whole sector goes up, 5 or 10 ATRs. But like we said earlier, even something that's highly correlated can have a big outlier, and the rest of the group may not follow along. And so you really are, you're really not covered if you're only trading a representative number. I mean, you may have to, because you're managing 20 billion, or you're only managing 100,000. You have to make these choices. But optimally speaking, you are going to miss out. I trade like four. I'm embarrassed, but I trade all four wheat markets, and there may be more than four, but I trade four. And Minneapolis has been the star performer, So you see it. Bean oil much better than soybeans. So yeah, trade them all. I've always known that in my heart. I felt that from day one. I had this ridiculous obsession with adding markets, adding single stocks that could give me some better diversification, and try to find stocks that had unique characteristics, maybe correlated to a commodity. And I haven't always done it.
What's actually interesting is when you look at the S&P 500, you realize that the entire market is being lifted up by 5 or 6 FANG stocks. And really, in the scheme of the S&P 500, they are the outliers. So you wouldn't have got all 5 if you hadn't diversified incredibly widely, because there's hindsight bias here. Would you have really picked those outliers, or it's our method of diversification that allows us to hunt for them and catch them.
And we keep trying to make our trading and our portfolio so perfect and so great, and listen to what others say to us about how we should be doing it with Sharpe and drawdown. And yet you have this most popular investment in the world that makes about 8 or 9% a year, with over a 50% drawdown, and people can't get enough of it because they're all doing it, but it's also because it's been so consistent. And so I think concentrating on how do we become more consistent, how do we make money more often, and if we can do that, I think we'll get more clients. They'll say, I know one year I made my best year ever, 93, I made like 65%. And I think John Henry made like 63%, or maybe it was the opposite. And someone was like, but your drawdown was a lot less than John Henry's. And I was like, that's so irrelevant. None of my clients even know what my drawdown was. They could care less. And I think just being consistently hitting these outliers and hanging on to those trades and making as much money as frequently as you can, which I think these long-term, robust trend following systems do. They're horrible with everything else except being consistent. And I think that is more of a secret than maximizing Sharpe and minimizing volatility and drawdown. To some degree, at some level, you've gone too much. You've got too much volatility. You've had too big of a drawdown. But not obsessing over those things, and not going to get uptight if I have a big drawdown in a trade that made a ton of money. And in order for me to make a ton of money, I had to allow it to have a big drawdown numerous times during the trend.
I'm glad your birds are okay, Jerry. I was a bit worried. I heard your dog barking. I thought he might have eaten them.
I need some help around this house with my family members keeping my pets under control. I posted on Instagram yesterday this video and picture of my wife holding a pig. It was this little tiny pig that our friend brought over for her to babysit, because she already has chickens, we have cockatiels, and we have these dogs. So pigs. And I'm like, no pig. And this pig started squealing. I mean, this was like an alarm going off, a smoke detector alarm, that was so loud that I think even she says in the video, I'm not going to get a pig. So thank God for that. And that's quite annoying to have all these animals.
Come on, Jerry. You were talking about diversification. I think you should take the pig.
Very good point. Very good point. I'm going to head out for lunch, but if someone wants to take over as moderator and keep going, I can assign that to someone who wants it. Just let me know. If not, I'm going to end the conversation. But it's been another good one, and we still have some of the unaddressed questions we can get to next time.
Well, thanks, Jerry. Thanks, Richard, and everyone for contributing, and see you next week.
Yep. See you next week. Thanks, everybody.
Thanks, guys. Thanks, Jerry.
See
Take
ya.
care.
Bye.
Bye.
Thank
Bye-bye,
you.
thanks.
It was very, well, thanks. Very happy discussion.